This video covers the fixed expected dividend model. The way a fixed expected dividend model works is to suppose that you have a firm that does not grow, has the same earnings, pays out the same dividends every period. The way you would generate that is exactly the same way as we generated a fixed perpetuity using a bank account in Unit 2. The interpretation for a firm, though, is instead of having a deposit in the bank, you have some amount of equity, E. You earn a return on it, just like the interest payment on a bank. It's the equity that you got times the return on equity. Then, if we pay that entire amount out in the dividend, next period's equity turns out to be the same as last period's equity. Again, we'll earn the equity times the return on equity. If we pay it all out as a dividend, the dividend's the same size. We start out the next period with the same amount of equity. And this just keeps going forever. So for example, consider a firm with a return on equity of 6% and an initial equity of $100. The earnings after one period would be $6. What I would do is pay it out as a dividend. The retention ratio, the amount I keep in the company, would be 0. Then my new equity is 100 again. Next period, I start with 100. If I earn 6%, pay it all out, have 100 again. This can go on forever. Now, I can't guarantee I'll always get a 6% return, so this holds an expectation. So the expectation for the firm is that the dividends will not grow through time. For example, consider what would happen if we had fixed dividends, or more technically correct, fixed expected dividends for an infinite horizon. Discounting them all back to today at the interest rate, the required return, would give you the present value of a perpetuity. So the present value is just the dividend divided by the return. Cross-multiplying says the return is the dividend divided by the price. That is, for a company that is not growing, all of the returns are in the form of dividend yields. So Yahoo Finance reported that Johnson & Johnson on September 17, 2013 was paying a dividend of 66 cents per quarter. The quarterly required return was 2.75%. That's an annual return of 11. It's a fairly reasonable number for Johnson & Johnson. What should the price of Johnson & Johnson be? Well, if we expect fixed dividends, the price today is just the next period's dividend divided by the return per quarter. So 66 cents divided by 2.75 gives us $24. On September 17th, the actual closing price of Johnson & Johnson stock was $89.91. This tells us there's something else going on in Johnson & Johnson besides the current dividend, expected to continue forever, driving the market price.